Welcome, startup founders and six-figure entrepreneurs. This is the 4-step entrepreneur-friendly way for you to avoid costly, false home ownership assumptions and renting your life away so that you too can secure a more sustainable and efficient net worth, all through understanding and outsmarting the banks. All of this, especially when you could have qualified with our proven entrepreneur-friendly 4-step mortgage finance approval all along. It's a process that also systemizes how to predictably increase your cash flow and net worth without working yourself into the ground. Welcome to the one-stop financial resource for entrepreneurs to find synergy between residual homeowner cash flow and making their quality of life better without needing to downgrade what gives you joy. The Tango Accelerator is a mortgage finance and quality of life accelerator, and it's really a done-with-you, no-cost, no paperwork or credit check needed method to increase your cash flow faster with less effort, so you too can accelerate your real estate dreams and decelerate your hectic life. Now, you can do this without unreachable down payments or the overwhelm of vague estimates from your bank. Also without the resentment of depending on old school banks and disjointed advisors who always give conflicting advice. You will see the step-by-step way to grow cash flow and life flow. And it's done through community. Why would you do it alone? Now, do you feel like you're renting your life away, both literally and figuratively? 1. You might think, are you grinding all day, piling up more debt as your friends work less and they make residual income in real estate? Taking the hard route sometimes can feel really futile. Secondly, maybe your bank doesn't understand your business and points out all the reasons why you don't deserve a mortgage or fit their very strict criteria. Perhaps your business sucks away most of your cash flow and your freedom, and you sometimes begin to resent working in it. Or you fear that another unpredictable world event will derail your business and you'll be left with less net worth and just more rent increases. So we have a crisis, and there's actually a crisis of waiting to buy real estate. In the last 20 years, home prices have increased 375% across Canada and up to 490% in the major markets like Toronto and Vancouver. I mean, look, homes are now 12.6x the average mean income in 2022. So it's getting a little bit out of control. And you'll see that actually compared to the US, Canadian real estate is far outpacing our income growth. And will continue to do so, and this is assuming you're stuck with a salary. But if you're a business owner with technically unlimited income upside, you'll be happy that you joined us today, because you're going to see how real estate can actually fuel business cash flow alongside giving you home ownership instead of slowing it down. So here's some costly wrong assumptions I see entrepreneurs make all the time, and trust me, I was there too one day. So one is wrongly assuming that entrepreneurs who write off too many business expenses cannot qualify for a mortgage. Also, wrongly assuming you need a bigger down payment than you actually do. Now look, as entrepreneurs, our Achilles heel is having way too many assumptions that we need to validate daily. And most are actually in the business that you run. Now the issue here is that sometimes you forget to validate assumptions on one of the most important purchase decisions in your life, and that's real estate. So look, if you applied for a mortgage in the past, or heard about the horror stories that your founder friends experience, you'll have heard about these two assumptions, which, while there is some truth to them, generalizing them to everyone and treating them as an absolute certainty is just false. I mean, think about it. This is as if you shut down your business tomorrow because you met another entrepreneur with a similar business who had to call it quits because reason X, Y, and Z. I mean, think about it. You probably would not quit your business until you're 110% sure that you should. So when it comes to real estate and hearing about other people who got rejected and quit the search, why would you do it differently when you're looking for a home? I mean, it doesn't really make any sense. We weigh things differently. Now, meet Tim Grasson. He's a tech entrepreneur wanting to buy a home and exit a business, which can be a tricky maneuver. He's venture funded, he's a fintech entrepreneur, and he's trying to figure out how to do both at the same time. Now, when I met Tim at a startup founder meetup in Toronto, he casually mentioned he was about to get a mortgage and that everything was under control, even though I could see he was clearly frustrated with the situation. So I asked, is it under control, and are you 110% excited about buying a home and potentially being distracted from your business? And he said, well, I do wish I would have written off less business expenses, thanks accountant, and saved more down payment. So he didn't seem to be fully in, and he clearly seemed a little bit torn. So the situation here the problem is he assumed you had to choose your business or buying a home. He felt that like there was too much of a sacrifice buying a home, given he was running a business, which, by the way, he was looking to sell his business. So he had to be really careful. So basically, he's got to find more down payment, and this is not possible unless he sells stocks in the market, which at that point were actually quite at a loss. So he was really torn there. And if he wanted to borrow money from his company, that was pretty risky because they were going under due diligence. And if someone saw that on the acquiring team, it would just muddy the solution. So he was kind of torn, right? So that happened. And he's got this dilemma, right? Do you defer the real estate dream and of course pay more later on, or do you jeopardize the sale of the company? Kind of a tough thing to figure out. And when I asked him, are you sure these are the only options you have? He admitted, hey, actually, I'm not really sure. I'm pretty overwhelmed with my business. Paul, if there's a better way to make this happen, please help out. I'm pretty much on autopilot with this. I just want to get it done. So I said, okay. You can access home ownership and have business security, not having the biggest down payment in the world and draining your resources for your actual business. So you don't have to choose one. We position Tim's income strategically to afford more mortgage and less money down. So he thought he had to put down 35% on a pretty big property, and that was a big difference. So you can actually position things differently and have the lender be more favorable to counting all of his income. Now, what's funny is alongside this, we got him a bigger mortgage. And, being a startup founder myself, I even found some new sales systems for his business, and I actually helped him unlock new cash flow channels. So Tim got the 360-degree win, and now we go for workouts and healthy dinners in Toronto. And as he has a new home and business sales systems, all about residually building his cash flow. The secret here is that sometimes getting a mortgage gives you ideas on other ways to systemize cash flow systems for your own business. It's pretty awesome. So this is an example, and let's talk about someone else, Marissa, another entrepreneur. Her business is very seasonal, which meant that not only is it feast or famine for her e-commerce business, but it also is for her life. So what did we do with her? Now here's the problem. Because her e-com business is cyclical, she wrongly assumed that a mortgage was only possible after she quote unquote saved a lot more, or that she somehow changed the market and made her business not cyclical, which is probably what the bank told her to do, which makes no practical sense. So she actually also used her rental unit for storing inventory, and every time a landlord sold the home, she lost weeks in productivity having to move, and if it was during peak season, that was like a total disaster. So what was the solution? Well, there are special lenders, not your bank, who don't need to see you in business for 2 years or don't need very strict criteria. They only needed to see 6 months worth of cash flow, which conveniently were from her peak season, and as little as 20% down payment. She literally took 15 minutes to get her finances organized with us for mortgage pre-approval, and she got over the blocker of, these specific assumptions she thought she had to do. So the value now is that she can open up new cash streams. She can buy an Airbnb property. She can grow off property appreciation. And now her life isn't all about living through the seat of her pants. So look, stick around until the end of this masterclass so you too can speak with us to discover how to experience breakthrough results as an entrepreneur, but also as a homeowner. Just a friendly disclaimer, if this is your first time here, In today's agenda and in a brief amount of time together, my goal is nothing except to leave you better in the following ways. Absolute clarity where there was once confusion, actionable confidence where there was once inertia for change, happens to a lot of entrepreneurs, momentum where there was once procrastination, something that I've fallen victim to many times, and leaving you with a playbook to efficiently dissect costly home financing assumptions while you sharpen your lens on efficient cash flow growth. That's what it's all about. And this is actually done symbiotically as you buy real estate and in your existing business. They do not have to compromise the other. Now, a bit of an introduction. So I've been recognized as a cash and life flow entrepreneur. I'm the founder of Level Up Mortgages. I am the co-founder of the Tango Sales Accelerator, and I'm the creator of the Grind Less, Flow More podcast. And basically, we've been recognized as giving a holistic approach to home ownership that levels up how you bring in new cash flow streams both in and outside of your business, all while making you less dependent on traditional banks and also venture capitalists. And since 2010, I've helped dozens of startup founders and entrepreneurs in what are usually very saturated industries such as real estate, food, consulting, finance, and help them differentiate and grow their cash flow and life flow, their freedom, without solely depending on outside financiers, and always need to go all in, and all in at all personal costs on their ventures. It doesn't have to be that way. So we free founders from the financial pressures through mortgage finance strategy and low effort automated cash flow systems. Just like it can be for you too. But, it wasn't always this way. And as for how this all came to be, my Dragon's Den moment in 2012 in front of 1 million TV viewers, this is a bit about my story. So there I was in 2012, standing at the studio at CBC's Dragon's Den, which of course is the Canada's version of Shark Tank, and the cameras were rolling. I had finally done it. I was on Dragon's Den, ready to pitch my startup for funding. The moment of truth had arrived, but it didn't really go as planned. So instead of walking out with a deal I thought would be fair, I had to turn down their aggressive deal and walk away, but I walked away empty-handed, which sucked, but I had rejected them. And I was disappointed, but I had rejected them, and they had rejected me. So I was going to now raise money from other investors at a better valuation and work towards a big exit. But even then, I don't think I had truly woken up. We were killing it. I raised money, and here's a photo of our first investor check. And looking back at it, while this was awesome, it just extended the pain of feast or famine, of always raising money and being stuck on a hamster wheel to keep raising money until your app finally goes viral. And this all happened until we couldn't raise enough money. And this is a photo of our what was a very lively office desk, empty. All of our staff cleared the office to find other jobs. And I was really starting to wake up. And this was truly a wake-up call. And that wake-up call was that I actually had to start to reject the Silicon Valley lie. I had to reject building a business with the monetize later mentality, which is usually talked about in Silicon Valley. And I realized that I was sick of people telling me, Paul, just build your app, go raise money, one day in the future to monetize. It's kind of like a casino, right? Skewed in the favor of investors and big VC capitalists. Now, what I realized is that really I was sold a lie. And of course, all of this happening while I'm burning out, living on a ramen diet, of course, not even thinking about real estate. So this is when I realized there's got to be a more sustainable alternative way to grow a business. And really, it started with a more sustainable lifestyle. I was burnt out from 300-hour work months, putting my personal life on hold and living with my parents until my late 20s. I had to change my day-to-day dramatically because that was affecting my creativity. So I bought into a better alternative. Create real cash flow, not fictional, in life flow. So after taking time to actually work less, I got a coach. He said, work less, create mental space, and start to understand if there's another way to make money, get to your goals, and still be fully autonomous. So as I had this mental space, and I was put through a boot camp really with a coach to understand how I can delegate more, how I can just really get out of this whole Silicon Valley bubble and mentality. And I started to talk to other founders around what other businesses outside of pure technology need help. What is completely either archaic or just needs to catch up with the times and is underserved, really. And I did swallow my tech founder ego here. And I came across mortgages, which I knew very little about, wasn't a sexy profession or a thing to do. And, at first I scoffed at it, but then I realized that the mortgage industry needed some serious help. And it was actually one of the simplest cash flow models out there. I mean, it was a very streamlined process, and the banks were just so brutal in helping, especially entrepreneurs. So this is when I had to really think about a different way to do things. And this is also when, more importantly, I had to prioritize my values. And really, I realized I have an emphasis on family, community, quality of life, and just grinding for money and one day hoping for $1 billion exit. It wasn't going to get me there. It wasn't actually a race that I wanted to be in. And I realized this as I've kind of zoomed out and started to question things. So what did I do? I left Vancouver for Toronto. I got a mortgage license. I combined it with my love for connecting people, technology, finance, and community. And in a really short amount of period, we got recognized as one of Toronto's leading new mortgage brokers who was helping entrepreneurs in unconventional ways and improving their lives. And my income went way up. I mean, way up. And none of it was borrowed by investors. It was all self-generated, hard, cold cash. I mean, it really felt too good to be true. And as my friends and colleagues noticed this quick transformation of how much freer and happier I had become, they began asking me if I could share my playbook to this quick life pivot. Because now I could work anywhere in the world, keep being my own boss, but finally I had my own money and it wasn't debt from an investor. It wasn't guessing. It wasn't raising money indefinitely or taking on bank loans. It was liberating. It truly was. It was a game changer. So our mission is how to make you geographically and Silicon Valley independent. That's you do not have to be tied to one location or rely on raising money or prolonging your life. So our whole goal is to level up entrepreneurs who are held back by either the wrong culture, the wrong assumptions, just like I was, to make more cash flow and be able to do so from anywhere in the world. And as I share this with you, please keep in mind, as a friendly disclaimer, that, well, look, neither my results nor our client results should be taken to mean we guarantee you the same. After all, I do not know you or your business situation yet. And until we speak, for now, all I'm promising you is that here's a step-by-step process that we and our clients have benefited from. And in return, really simple. I want you to follow through and implement as a full-time six-figure or soon-to-be entrepreneur with big business and home ownership goals. And please don't be like those who watch a bunch of masterclasses and then do nothing because they overcommit. Commit to taking focused action and benefiting. Once again, I want you to implement. Do we have a deal? And in our brief time together, we will review 4 steps. So number 1, identifying what are your costly false home ownership assumptions that keep you renting. What are those blind spots, things you assume? We're going to squash those. Secondly, we're going to embrace a very little known unconventional secret to an instant higher net worth and a faster mortgage approval. This was partly what I went through as I made my transformation. Step 3, secure your future to a higher long-term net worth by actually questioning lower mortgage interest rates. And step 4, it's investing in a proven, done-with-you service to optimize and integrate your life. Step 1, identify your costly false home ownership assumptions that keep you renting. So again, there's a crisis of waiting. We went through this. Properties are growing at exponential appreciation. And every time we wait, remember this chart, you pay more. It's really that simple. Now, you should never rush into buying because you really have to ask yourself if you're ready for it, if it makes sense in your life. And I mean, just ask, are you waiting out of fear? Are you waiting because of some, obvious logical life circumstances, or are they false assumptions and you really would be open to it? So let's get into that. So what false home ownership qualification assumptions have you waiting? So a big one here is you wrongly assume that entrepreneurs who keep money in their company cannot qualify for a mortgage. So basically, if you have retained earnings, is that really a mortgage killer? Do lenders not like that? Well, lenders don't care. That's actually totally fine to keep money in your company, right? And the second one, this is an assumption that kills me. So you wrongly assume that you get blacklisted of lenders if your credit score isn't perfect or if it gets heart checked by a broker. I understand people who have got a bunch of credit cards and perhaps, capitalized on the whole travel point game have probably seen their credit scores go way down. Look, it's different with a mortgage. When you get heart checked on a mortgage, Equifax or any of the other credit score companies, they don't dock you nearly as much as the credit cards because you're applying for a mortgage. You're adulting, that they're okay with that. And you only need really to have over a 600 score. Remember, it's out of 900. So if you have like 620, 650, 680, 700, 750, low 8s, you are more than good. It's okay to get a hard credit check so you understand where you are in terms of getting a mortgage. Really, when you get docked or hit with a hard check on the credit score side from a broker, you lose 1 or 2 points and you get those back within the month. So please do not be a credit score perfectionist. You're not going to get a better rate by having a better credit score. You just got to be over the threshold. It's very binary. So do not let this, muddy the waters and give you a fuzzy, understanding of where you stand. I see it way, way, way too often. Another set of false assumptions, especially false wealth building assumptions, is a lot of people think that you wrongfully assume that buying a home means you can't invest in stocks until the mortgage is paid off. So if you put capital towards a home, you can't invest in stocks, which partly is true. It's an opportunity cost. Now, however, something that very few people know about is that you can actually use home equity, because as you buy a property and it appreciates over time, you can pull out cash. You can pull out cash and invest that in stocks, and you actually get tax write-offs through something called the Smith maneuver strategy. So you can actually benefit from home appreciation and investing in stocks and having the compound interest. Of course, you accumulate a bit of debt, but usually if you actually compare cheap debt with compounding growth in the stock market or any other asset class, most of the time, long term, you will more than earn money. And that's something you can, of course, talk to me or a financial advisor about, but it's not having that assumption. You can still invest and get benefits. Also, people think a lot that you wrongly assume you cannot own a home until your business is quote unquote established. So established can mean a lot of things, and many people confuse this for needing to be in their second or third or fourth year of business. You can actually qualify after 1 year. So let's look at another case study. Meet Jordy Tate. So Jordy Tate is a new business consultant and entrepreneur. He's a coach for tradespeople looking to grow their businesses. He worked at 1-800-GOT-JUNK, super smart dude. And he's a new consultant working remotely. He just got out of his job and turned his employer into his client, which is an awesome way to do things. And he's always had a dream to buy a home with a garden and be on the Sunshine Coast of British Columbia. So what were his wrong assumptions when I talked to him? Because when I talked to him, I said, he was curious about one day getting a home. I said, well, what's stopping you to doing it right now? Have you checked your credit? Have you talked to a broker? Have you done any of the math? He's like, no, I just assume, I'm new in the business. I heard from a friend, you've got to be well established. Yeah, I'll wait a few years. I'm like, okay, well, number one, he was wrongly assuming you need to always make more than today's income to qualify for the right mortgage. So he thought, even off the small amount of income he was drawing, that he had to make more. Well, I told him, have you quantified it yet? He hadn't. right? And then he was wrongfully assuming that entrepreneurs always need to save more money than others to qualify for a mortgage. I mean, I really think it's time to eliminate these blanket statements that are really putting you into the crisis of waiting and paying more in the future. So these are two assumptions that both Jordy and his life partner, both self-employed, again, they had heard about it from other people, and they just hadn't actually done the math, right? And it's all really case by case. There isn't a hard rule that entrepreneurs have to have more salary and more down payment. It's the same math. The bank does not treat you differently from someone who's employed, as long as you have the right income and the right down payment. And we'll get into that in a moment. But that's a really important thing that I told Jordy, look, let's do a quick audit and see where you're at. And so the problem was he needed quote unquote more consistent income and savings. And again, he had these wrongful assumptions. And he also assumed that he couldn't take any down payment money from his company, nor could he get gifted from relatives. And these were all false. So once we actually went through it, I mean, this is basically the solution. You can actually buy today with special lender exceptions. And again, they already were qualified. The day we talked, I said, I did the math. I told them, you're already qualified with everything we talked about. So number one, the lender we spoke to actually counted his business income from his first 14 months versus, look, conventionally, lenders want at least 24 months, 2 years of you being in your business. But because he had worked in the same field, the same employer is literally the same job. He just changed his job title to be self-employed. We got an exception. And they were also allowed to use 100% of their money for down payment as long as they own their company outright. And they did have that. They're just a small business, right? So, lastly, gifted money was allowed as long as it's from an immediate family member. So all these false assumptions, immediately Jordy realized, there's actually a better way. So he bought a house, got it on, I think, his second or third offer. And now he's got Airbnb side income, which was never a thing for him before. He travels while they make income, whether it's Airbnb or appreciation. It's already gone up $50K in value. I mean, this is like literally a year later. So this is a quote I love that Jordy said. This is an entrepreneur. I can make more bold business decisions knowing that I have an appreciating and cash flow property to hedge my bets with. Right? So he can take bigger risks in business because worst case, he can turn his house into a full-on Airbnb. He has an asset working for him residually, and then maybe he'll take bigger business bets. So this actually changes your mindset. It gives you more confidence. It opens up more cash flow streams. In case your business goes under, you've got something else to fall on. He can also take out the equity to invest in the stock market, buy new equipment. I mean, it's pretty amazing how he's intertwined the whole thing. And this really leads on something that I call the linear or exponential mindset. So think to yourself, linear mindset. Most people, they say my income increases steadily and I just got to keep saving. That's just how it goes. But the exponential mindset is my income can compound. It can grow faster than a 2% savings account. It can go in real estate. And so if he would have kept his head down and kept saving year after year to one day own a home without a chance of rejection, he didn't want to be rejected from the bank, right? He would be in the blue line, where you depend on one revenue stream. I mean, it's a slow linear burn. So instead, Jordy chooses the green line, where he adds 2 new revenue streams beyond his work income, rental income and home appreciation. And look, if he wants another investment property, those $50,000 his home appreciated can be pulled out of his house for a down payment. So he doesn't need to wait another 5 to 10 years to save up again. Home appreciation is residual savings. So think about, what is your mindset? And this leads to step number 2, is to embrace a little known unconventional secret to a higher instant net worth and a faster mortgage approval. Optimize relative per hour income, not absolute income. So we'll get into what this means in a second. Now, mortgage lenders, essentially, they have a problem, even if you make enough income, but if it's made unsustainably, i.e. you're burning out, you're putting in way too many hours across different businesses, they will reject you. So what is relative income? Let's look at this video here on the right. So what is what's better optically for a lender and for yourself? If you make $48K a year, but you work 20 hours a week, or $100,000 at 60 hours? Well, do the math. If you extrapolate this across a year, you're making $50 an hour when at an average of 20 hours a week. And if it's 100,000, well, working 60 hours, that is only $35 an hour. So really, it's how efficiently can you make money? And that, of course, was popularized by best-selling author, entrepreneur Tim Ferriss in the seminal book, The 4-Hour Workweek. And these are principles and potential blind spots on how you're making money yourself now, that if you fix them, they will not only open up more time for you to be happier and, of course, make more in less time and work smarter, not harder, but a lender will actually have a better chance at accepting your story and making special exceptions. Look at your relative income. Just the way the video talks about, it exposes unsustainable business streams. So with me, here's the math. I only paid myself $3,000 a month. And that was because I was told, keep the rest of the money in your company. One day you exit at $1 billion. You eat last, which I get to some extent, but this is happening for years. 300 hours a month. So you divide those two numbers. I actually made $10 an hour. And this is Cole who said, Paul, do you realize that you're only making $10 an hour? If you want to double your income, we're going to do it a bit differently. We're not going to just double your income overnight. You're going to make the same amount of income this month as last month, but you'll work half the time. So the process was letting go of things, working smarter, having a better relative income. And that was actually super important. So before this, look, I had hoped to sell my business for millions of dollars. And meanwhile, I qualified for a $150,000 mortgage and I had no down payment. There's no chance I could live in Toronto, Vancouver, let alone Canada at this point. Like, I was way off. And this was really, I guess, a wake-up call, driven by understanding that I'm working unsustainably. Mortgage lenders will not want to approve me because I'm unsustainable. And just my revenue numbers don't make any sense. So this is kind of where I really turned around. I took Cole's advice and I thought of sustainable ways to build income, and in the spirit of affording a home and just having a better life. So once I let go of anything that wasn't generating income and could be delegated to someone else, I had a lot of free time to explore opportunities. And this is back to my story. This is when I had the time to discover the mortgage broker industry and understand that it was broken for entrepreneurs. And I started Level Up Mortgages. And that was something we did to approach the mortgage process differently and with more education. And these are the results. I mean, a year later, I had 6 times more income, but I did it in half the time. So my relative per hour income actually went up by 12x, right? The 12x income. Imagine, you go back to the formula, right? Your income goes up by 6x. Your denominator of actual time put in, right? My 300 hours went to 150, and my dollar per hour went up 12x, literally all in a year, right? So imagine for yourself, if every new hour you worked, you made 12 times more money. Now you can buy a home anytime. I can buy a home, and you're making sustainable income without burning out, which not just mortgage lenders appreciate that, but so will your spouse, your family, your friends, your health. The whole thing is holistically improving what's broken now and getting out of grind culture. So if you get this wrong, again, lenders will reject you due to burnout risk. So even if you make enough profit for mortgage approval to actually work, if it's inefficient and they can see you're working more than 2 jobs or more than 2 startups, you can risk rejection. And that's the worst thing ever. Now, improving your relative income for faster mortgage approvals really requires a mindset shift to be the owner of a system. So look at B and I here in this column, right? So this is basically looking at having exponential residual income versus linear income, predictable income. So you want to be on the right side of the quadrant. This, of course, was all popularized, the cash flow quadrant, by the seminal personal finance book, which talks about having systems and investments to have money work for you. So look, if you're an employee, or even if you're self-employed, like I don't ever call myself self-employed anymore, because self-employed people, they just own a job. Yes, they're autonomous, but they're trading time for dollars. They're not trading value for dollars. So that's a really important thing, is you want to have a system that builds for you. So as a business owner versus self-employed, you've got people working for you. You have systems. You can step out, go on vacation. If you get injured, this thing still runs. It's kind of like real estate. So you want to move to being a business owner, and of course, at the same time, invest, buy real estate, buy things that are leveraged, that they give you a great leverage on your time. So that's where, again, it's a whole mindset shift that's going to be super important for you to thrive. So that is huge for getting a mortgage. And now more specifically, It's all about the long-term game. Remember, mortgages are up to 30 years, and sometimes lower interest rates might actually make you less wealthy and more stressed out. This is very contrary to what you hear in advertisements, RBC ads, but there's always a catch when you buy something cheap, whether it's a car, plane ticket, or a mortgage. So let's dive in. Paying a higher rate today can give you speed in wealth building. That's right. Paying a higher rate can give you speed in wealth building going beyond your bank. So do not be afraid to pay a higher mortgage rate with an alternative lender now if it means you'll be wealthier in the future by owning a home faster, not being the prey of that graph I've shown you a couple times, where things are appreciating up to 490%, and you want to residually be building wealth through rental income and home appreciation. Every day that money is not put to work in real estate, you're missing out on rental income and home appreciation, right? So look, these lenders usually are more relaxed, right? They have slightly higher rates, only really 0.5 to 1% more, but they care less about your credit score. They can be more flexible in down payment. And, in contrast, these best rate lenders like the traditional bank, they're so strict. And they'll do whatever they can to make you have the biggest down payment, make the most income, and wait years to qualify for a mortgage, all while property prices run away from you. So if Jordy had waited a year, he would have paid $50,000 more for the same home. Now, here's a case study, really interesting. So brilliant story of a salaried employee who actually rejected his bank. He outsmarted them. He understood, of course, more than what the bank can do. Of course, you're talking to me. And his whole thing was his bank wanted him to pay an obscenely high down payment, and the bank wanted him to pay off some debt. So what he did as this kind of entrepreneur, because he's an investor, is the bank says, hey, pay off some cheap debt. And by the way, what he did, I don't recommend this to everyone, is he took on debt to actually leverage himself to invest in Tesla right at the perfect time. So he has this incredible Tesla stock, right? It's going rapidly. And the bank says, we don't like the debt from that, 5% line of credit that you took to now make, 50% a year, 100%. Pay off the debt. To pay off the debt, he's got to sell his stocks because they're still going up. And he thought to himself, that makes no sense. Sure, I'll get a cheap bank rate, but why would I lose on the upside of my stock to pay off cheap debt that, it can pay any time? Didn't make any sense. So he talked to me, he said, hey, is there a different way to do this? Because yes, it is a cheaper rate, but my overall net worth will go way down if I pay off this cheap debt. It doesn't make any sense, right? So that's where we connected. And he rejected the bank. He outsmarted them, and he understood how they thought, but he said, okay, well, what if we go to an alternative lender, which, by the way, these alternative lenders are completely regulated by the banks. They're actually owned by a lot of the banks. They're just more flexible, and they've got slightly higher rates. They only do 1-year terms. I mean, usually banks do 5-year terms. You can literally do a 1-year term. It's a Band-Aid solution, and he paid maybe a 0.5% more. And he thought to himself, okay, well, if I pay a little bit more, I might pay a few $1,000s more with this lender for 1 year. But then I'm continuing to keep my money working for me in the stock market, not to mention the money he didn't have to put down from extra down payment. He could invest in other things, right? So he sacrificed not having the lowest interest rate in the game, and maybe paying a few $1,000s more, but he made thousands more from not selling his stocks, not paying off debt, and also not to mention, if he would have waited a year, the same property would be a lot more expensive. So he raced against time, and he just had to pay a little bit up front. Look, as a business owner, you know this. You've got to spend money to make money, and this is that's no different when you buy a house, right? You understand this. So again, he had to just change his mentality. He has less debt and a lot more money in the bank to reinvest in real estate or stocks. And he's got more net worth and passive income, which makes him dependent on his employer less. So what happened actually is at the end of the year with that alternative lender, his stocks hit a plateau. He sold them, made a bunch of money, paid off his cheap debt. Now he could fit into the strict bank's policies, but he had already gained so much. He gained $100,000 from the appreciation, his stocks. And sure, now he can put in a bigger down payment or pay off his debt. Here's some actions for you to run the numbers of opportunity cost. It's a self-audit. Number one, how much more is an alternative lender than your bank? Literally, don't be emotional. Break down the numbers. With Jerson, it was less than 1%. If you annualized, 1% more on interest rate versus the bank, it was only a few $1,000s. So run the math. Do not be emotional. Now think about how much do you lose by chasing a lower interest rate with strings attached. If you can qualify, if you have the luxury of qualifying for a bank or an alternative lender today, but you see the strings attached and you see how much down payment you have to put down, debts you got to pay off, just do what Jerson did. And literally, this can be done very simply, and I can help you through this. I'll even Excel doc for it, and it's black and white. So run the numbers and think about, are you more profitable long-term if you play it safe to pay off current debts and sell current investments, or long-term, are you better off paying a little bit more right now? So start to wrap things up. I promise to teach three things. Identifying your costly home ownership assumptions that are keeping you a renter and making you miss out on opportunity cost of property appreciation. Second, it's embracing little known unconventional secrets of the opportunity cost to a higher long-term net worth, even when it hurts up front. Remember, I had no concept of relative income. I was working way too hard, but it felt safe. And I had to let go of so many things to change my mindset and make a more sustainable income and have a more efficient net worth. And it worked wonders for me. Thirdly is securing your future to a higher long-term net worth by questioning lower interest rates, questioning your bank, questioning all these promotions they dangle in front of you. It's all about dollars and cents, not just today, but in the mid to long term. And this is how you outsmart the banks, by understanding their world, but using all your resources. And I think it's super, super important. So now, last step. The last step of this masterclass is to invest your attention and invest with us, invest time, not money, in a done-with-you service to optimize and integrate your life. That's what it's all about for the entrepreneurs and the people that we work with, and I think where people are at post-COVID, right? So what does this look like to optimize both your business and your cash flow so you create life flow, life freedom, ability to travel, ability to not be stressed, to not be burnt out? What does this all look like? So summarizing, look, I'm going to challenge you to stop betting it all on the Silicon Valley casino or traditional banks. You now have ways to outsmart them, to understand their world and use them strategically, but to depend on them on their terms is crazy to me. And it took me time to realize this, but it's crazy. Entrepreneurship takes a lot of time. So any form of passive income can be extremely valuable. A lot of us are pre-programmed to have this be this overnight success. But look, we all know it's a long and hard journey. So spread out your risk. It's worth it. And look, you may have right now too many disjointed advisors, or you're trying to do it yourself. And here's the problem with that. You have a bank, another mortgage broker, you have, an accountant, you have a financial advisor, you have, your friend's dad who invests. You usually get conflicting advice from other advisors who don't understand the whole picture of your business. This slows down your mortgage process and could actually cripple your business at the same time. I mean, for example, Tim's accountant, like anyone's accountant, write off all the income, save on taxes, but then he can't qualify for as good of a mortgage. Same thing with Jordy. Like, the accountant is not doing your mortgage. They don't understand the full picture, let alone they don't understand, where your business is going. So you need someone to really integrate things holistically, and that's something that for us is super important to do with you. And look, DIY I think is great in the early days, but a lot of people actually try to DIY the whole process. And doing the planning yourself can actually mean that you make wrong decisions. Do not assume you're wasting our time by asking for help early. It's okay to ask me in the early days, am I on the right track? Remember, like Marissa did that literally in 15 minutes, and she's just completely changed how she's approaching things. So this is the ask: to work with a proven advisor. Work with an advisor who can validate your home buying assumptions quickly and ensure that you help rather than harm your business and net worth as you plan for buying a home. So get helped and let go of this pre-programmed, bank mentality, having to fit all these boxes, waiting indefinitely. There's a lot of short-term thinking that we have, and it's all about keeping sustainable cash flow and life flow, especially when it seems out of reach. No, we want to be sustainable now. That's going to help not just your mortgage approval, but your actual business. Think more broadly. This whole presentation has been about earn a holistic return on investment. So owning real estate as one main asset class, and it opens up passive cash flow and a better quality of life flow. So holistic ROI is where your whole life appreciates in value. And this is where you're embracing feeling the ownership of actually owning something safe. You get joy from owning a house. You can, build your own studio, have a productive space, do better home workouts, have more guests in and not be afraid to have to, be booted out the next month so you can't renovate it. Like when you own something, you can actually design your life to be more productive and healthy. You can get closer together with your relationships. I mean, just the feeling of home ownership for the right reasons, not ego, but to actually invest in your space and being healthy. Everything rises up. It's your money, but also your life flow, your freedom. There's just so many things that a property can do to up level everything. That's why I like it more than stocks, because it actually is an experiential thing that has so much more of a return. Most startup founders and six-figure entrepreneurs that we covered assume that their banks and their money advisors had solutions to build their whole wealth. They didn't. They did the opposite. With Tim, his accountant, as I said, he saved on taxes, but he now had to pay way bigger down payment, or he almost didn't have a home. Marissa, same thing. Her bank didn't like her seasonal fluctuations in her income, so she had to wait. And she had to keep, moving and being stressed out and moving while choosing her peak season. It was terrible. So insert your name. What is holding you back from being a success story, right? How can you be like Jordy, who didn't waste time? Jerson, who was totally entrepreneurial and actually paid a higher interest rate, but he ran the numbers. And he didn't just assume he had to wait for his bank because the alternative lender was a loan shark. No, he actually did his homework. It didn't take long. And again, this is just a way for you to think about what is holding you back. I can obviously help you with that. Our team can. So book your clarity call today. And if it's something that you feel that you could get my help with, book this call. And what we'll do, it'll be a mortgage qualification and a relative income audit at no cost whatsoever. So we're going to understand, are you making income sustainably with the right systems, the right revenue model, right? That's a key part of it. But of course, the major part is, are you qualified for a mortgage? Are you on track for it? What's missing? Are you potentially working unsustainably? And do you risk the bank asking more questions? Or of course, other lenders. There's way more lenders outside of banks, usually with better rates and more flexibility. So really, it's book your clarity call. Get clarity so that you are not letting the market get away from you and just in this hamster wheel relying on, your bank or venture capitalists. There is a better way. So I want you to implement now, right? Please implement, take a step. Thank you for your attention and good luck with your journey. We'll talk very soon.